CPI comes in lighter than expected and consumer confidence takes a hit. Bond yields roll over, but equities remain pinned into options expiry. And gold roars back after speculators cut their positions in half. All this and more in this week's Macro Insight. Welcome back to Macro Insight, everyone. Today is the 17th of August, and let's take a look at these markets. So, what's been going on? S&P continued to kind of eke out higher levels last week as we've been approaching August options expiry this Friday, as I've been flagging. The 4450, 4475 area appears to have some pretty decent gravitational force, as you know, this large dealer gamma positioning has been sucking the market in there and really making it quite hard to move anywhere, despite various headlines. And we would expect this to reduce significantly on Friday, right? So we see this cycle happening pretty regularly. Market gets caught in a bit of a long gamma trap, vol collapses, realized vol collapses, and despite the perceived risks going into the future, the market just can't really break out of the range, right? So that's certainly what we've been seeing. If I share my screen, you can see this kind of range that the S&P's been in. Now, it was a pretty tight range, about 1% range the previous week. And that's gradually started to extend out a bit. Nothing too dramatic, but after the weekend's events, we definitely saw, with the news of the Taliban taking control of Afghanistan and the US pulling out their troops, that did send a bit of a nervous shockwave through the market. Not that we got any major move in US, for example, but still there were nerves there. We had this dip down to 44.40-ish, and then market ripped back higher. But that amount of intraday volatility is more than we've seen, for a good couple of weeks. And so that's showing me signs that we might be getting exhausted on this pin. As maybe even before it expires on Friday, but certainly after it expires on Friday, we've got the potential for a lot more movement. And you've seen that even overnight after hitting that 44.80 area, we've managed to pull back a good, almost 30 points. And that type of intraday volatility we haven't really been seeing, right? So 44.50 still does seem to be the gravitational point. We keep getting sucked around there. We're struggling to move away. But, the headlines are not getting any prettier, basically, right? So something to watch out for. The US politics has already been in a bit of turmoil for those who have been following. All the talk about the voter fraud hasn't gone away. Various counts have been going on, forensic audits, as they call them, for the election in various states are still ongoing. I mean, I was surprised to hear it myself, but I dug into it in a bit more detail. And that surprised me, but it's still going on, right? So US politics in a bit of turmoil. This isn't going to help matters, right? This is going to give the Republicans more ammunition to criticize Biden. Could undermine his ability to pass economically stimulative fiscal measures, which we know are going to be needed. It's kind of an ongoing theme that we would expect, this administration wants to keep doing. It might make that harder. So far, US markets have shrugged it off, right? But I do think we need to wait until OPEX. Once we see options expiry pass, the market still continues to shrug it off, then, maybe it's not going to have that much impact, right? But for now, the jury's still out, and I wouldn't be surprised, towards the end of this week or even early next week to see the real move if this continues to deteriorate. Yeah. And, we've got I think they've given them like a 2-week evacuation ceasefire period, basically, to get everyone out, right? So, I don't see the news flow getting better after that 2 weeks is over, basically, right? Let's see what happens. Looking at the vol, obviously in a bit more detail, we can see on VIX Central, so you've got the VIX level at around 17 now, a bit higher now, but basically massive gap there, right? Between realized vol, 10-day realized is printing 5.5. So just telling you how pinned we've been relative to what the implied vol, which is the forward-looking number at 17 odd, saying that there are some risks coming over the next month, even though we can't move right now, right? So that implied realized gap pretty much as wide as you can really ever see it, yeah? If we take a look at the, take a look at the actual VIX itself, yep, 17.25 right now. You know, I've been looking for a move, like a final leg down towards that 15 area again. We kind of literally touched just above that. And now we saw this bounce obviously over the weekend, right? So I kind of think there's a good chance that the VIX has bottomed in the short term with that last little test above 15. And now we're back at 17, right? Remains to be seen what happens into the end of the week. But it's certainly showing signs that it may have bottomed there, basically, right? If we look at the sectors, kind of sector leadership, what's been kind of holding up the S&P, that's quite interesting. That's been mainly defensives led, right? So you want to have a look at this chart. It kind of shows us, you know, utilities, staples, healthcare. That's kind of what was in the sort of 1.5 to 2.5% kind of appreciation last week. And then the more cyclical, the more higher beta stuff kind of struggling, right? So what does that tell us? That tells us that maybe, you know, even though the market's holding up and people have got equity allocations, they're seeing what's going on, you know, their macro growth expectations are rolling over a bit if they look around the world at what's going on. And, you know, macro expectations rolling over. Here's something put out by Bank of America, you know, the net percentage expecting a stronger economy, that's rolling over. That kind of, you know, gets tracked by the kind of equity allocation, and equity allocations are still up here. And I think that's a bit because investors are like, you know, there is in that TINA mode, there is no alternative to owning equities. Bond yields have obviously gone down again. What do you do? So it seems like rather than just getting out of equities, investors are either rotating into defensives or they are buying hedges, which is why we see skew quite elevated, right, as people have been flagging. And so that's kind of seems to be what's happening. Now, if things start to deteriorate, you know, that equity positioning may still need to kind of catch up a little bit with those expectations of kind of slightly weaker growth, right? So that's something to be aware of. What did we get last week? What else? We had University of Michigan confidence rolling over. That was a little bit of a surprise. It seemed, given the bond market reaction to it. So yields came off quite hard after that number dropped, came in at around 70. You've also got, you know, people flagging their, you know, reason why confidence was a bit lower. Real wages are a concern to people as, you know, inflation expectations are rising, but their nominal wages aren't so much. Unemployment benefits and forbearance plans are also expiring soon, right? So, you know, a lot of people have had a pause button on their mortgages and haven't had to pay. You know, if that does start to run out, it's supposedly running out or scheduled to run out in around September, October time for a lot of people, then people may then need to sell properties because they can't afford to pay their mortgages. Does that put pressure on the housing market? Just at the same time that the Fed is kind of signaling that they might taper, you know, asset purchases, and people are saying they shouldn't be buying MBS anymore, given where the housing market is. So all these factors may start to come into play. And these are things that are on the horizon that are making people a little bit more nervous, right? Now, like I say, the US market, US equity market, ignoring it all for now. Which markets aren't ignoring it? Well, certainly Asia's not ignoring it, right? So, you know, Chinese ports have been shut over the last couple of weeks because of the COVID scares. You know, that's not done any wonders for the Chinese economy. You had factory output and retail sales in China disappoint. that came out over the weekend. Early Monday morning, I think that number's printed. So these things aren't great. And the US, and sorry, not the US, the Asian equity market seem to care, right? So if we have a look at what they've been doing, whilst the S&P sleeps, we've definitely had Kospi rollover. Obviously, China's been weak for a while, but Nikkei's rolling over a little bit. Kospi particularly bad, right? Because they're the big exporter, and so that whilst the S&P's sleeping up at all-time highs, Asian markets are certainly starting to reflect some of the concerns for what's going on in China, what's going on with global growth, right? So maybe a leading indicator there, basically, right? Certainly, this often happens in the price action where you see a lot of other things roll over first, and the S&P, the US equity market is the last to go. We've kind of seen this pattern before. Now, I don't know, I'm starting to feel more and more like, the S&P's been ignoring a lot, right? And people have been parking their money in the US stock market. But at some point, if these factors can't bounce and we do continue to see this rollover in a lot of macro indicators, it's going to be hard for the US to ignore it, basically, right? So I'm definitely getting more cautious looking at what's going on all over the place. Yeah. And then, is the Fed really going to taper by year end? 84% of those surveyed by Bank of America fund manager survey, right? 84% they're going to taper by year end. When are they going to signal that tapering? Well, it was kind of a month ago. It was definitely Jackson Hole was the favorite. But now, expectations are moving more towards the September FOMC. So, watch this space, but it definitely looks like September FOMC is becoming the event. And if we look at what VIX was doing, I was saying VIX was holding up because Jackson Hole was an event. Not so sure Jackson Hole's the event anymore, right? So I think September FOMC is the one. The VIX futures in September are kind of reflecting that. They're trading at a decent premium to where the August futures are. So, I think that's the market consensus is forming around that. But, some people don't even think they're going to taper, right? You look at this economic surprise index rolling over, you look at what's going on in China, you look at what real yields are doing, yeah? Real yields are saying that the Fed isn't really going to deliver on the taper, right? If the market really thought we were going to get a taper, you would expect real yields to be rallying a bit on that, but we're not seeing that, right? So, remains to be seen. Some commentators think that the Fed is talking more hawkish than they actually really are. And so they're kind of, giving the threat of tapering to keep market from sort of bubbling over, but they're not really going to deliver it, or they're going to try and delay it as long as they can do, basically. And historically, we have seen that type of behavior from the Fed before, where they talk a lot more hawkish than they actually are, and they tend to act a bit more dovish, right? So that's certainly, if you look at what real yields is doing, that would confirm that. And, gold in theory should trade in line with that. We had a strong recovery on gold. We'll talk more about that when we go into commodities, but, that might be the play there, basically, if that's your view. Okay, if we look at FX and rates, what's been going on there? Dollar had a bit of a pullback, right? So the CPI number was your kind of opportunity for the dollar to break to the upside if we've got a big number. We kind of didn't really. It was in line to slightly weaker. So that gave us a pullback in the dollar back to sort of 92.5, and now we're just bouncing around, right? So bit of no man's land, really. If things do get out of hand on the geopolitical side, the flight to safety bid to the dollar maybe comes back. So you saw a bit of that yesterday with the dollar bid and treasuries bid. So something to keep an eye on. But right now, dollar kind of in no man's land and struggling to really break through that 93.20 level. Bonds, obviously, like I said, after the confidence number came in weak, that kind of, really accelerated that move down in the bond yield, right? So I said the bond yields were going to struggle to break that 140 level in the 10-year. We had a reflexive bounce off these oversold levels. Downtrend still intact, and you can see that's rolled over again. So there's your 10-year, there's your 30-year, not really doing any damage to that downtrend, basically, right? So those things look to be firmly in place. no reason to question those downtrends in yields at the moment. And like I said, the kind of stuff we're seeing out of, growth data disappointing, and what's going on in Asia right now with all the port closures, I think that's going to negatively impact growth, basically. And we're seeing that. Yeah. So in FX, other than that, really, Aussie dollar, obviously quite linked to Asia and what's going on there. That's breaking down to the downside. See Aussie making some new local lows there. Pound and euro, pretty boring, to be honest. They're just going to kind of move in sympathy, whatever the dollar's doing. And for now, the dollar's kind of deciding whether it wants to break to the upside or not, basically. Yeah. So that's kind of pretty brief summary on rates and FX. Commodities, like I said, been quite interesting in gold. Gold had that massive move down, obviously, on that Sunday night print. It's been straight up since then, basically. It hasn't looked back. I mean, pretty violent move there, right? So you had quite a bit of de-risking in gold on that flash crash. So spec positioning apparently was cut in half on that move. So that's kind of lightened that up, and now we flushed that money out, and now we're seeing this bullish move back again, right? And it is actually kind of moving in sympathy with what real yields are doing and stuff like that. So can it pop its head back above 1800? 1830 was the real big sort of resistance they were struggling to get over. I probably think 1800 is the first one right now, and we're not far from it. It's probably being helped with some of the stuff that's going on geopolitically. But, jury's out on gold, right? Tough to really see. I mean, if they do deliver on tapering, gold probably stays under pressure. If they don't, then maybe gold's got a rally in it, basically, right? So right now, the taper talk and the probability of tapering is going to be a big driver for gold. Yeah. Oil, on the other hand, has been particularly interesting. Kind of thought we were getting a strong bounce off that 65 level, where we went straight back up towards 69, but we rolled over again, right? The Chinese story, sort of hitting demand for oil and things like that. That's kind of impacted oil in the short term. Looks like this consolidation might still have some room to run, right? The big levels, big key supports that I'm seeing on oil are kind of still there. We've got that 65, low 65s is a big support, which we bounced off twice. If that were to break, I think there's another key one around that sort of 62.5, 63 area, basically, right? If I've traded around my position, I did buy some gold, not gold, I did buy some oil, 67.5. I bought again at 65. I flipped out the purchases that I bought at 65 when we went above 68. Just to trade around it and give myself some room to rebuy if it dips again. And it's kind of smelling like we might get that dip again. Obviously, Biden called for OPEC to increase production. They pretty much said no. That's why the oil managed to bounce yesterday. But if we do get risk off type moves over the next couple of weeks, which I suspect is what we're setting up for, then oil's not going to escape that, I don't think, right? So oil is high beta risk asset. It will probably be dragged down with global market weakness if that's what we see. So something to be aware of. If you are light on your positioning and you've got powder to put to work, you'll probably get some nice dips on oil to be able to buy into, right? Like I say, no harm in having a bit of an allocation now, but I'm leaving some bullets to kind of buy more at lower levels, because I suspect we probably will see some lower levels, right? That's what it's looking like to me. And then in terms of the other commodities, whilst you've had a bit of weakness in copper and oil and gold, you have had grains doing pretty well. So you had some data out on grains, on wheat, on corn, etc., that triggered a bit of a rally. Wheat's been doing extremely well recently. You can see here, it had its consolidation back in July. It's been rip-roaring since then. Corn consolidated for a while, has rallied recently as well. Soybeans, similar story, consolidating, had a little bit of a pop recently on the data that came out. The data that came out in terms of crop reports was showing, drawdowns in inventories and things like that, right? So So that kind of catalyzed a bit of a pop in that space, right? But positioning seems to be moving into some of those agricultural commodities and out of things like copper and oil of late, basically. Yeah. Thanks for watching, guys. If you like this content, please subscribe to our channel, give the video a thumbs up, and hit the notification bell so you don't miss out on future videos. To watch the entire macro call, which includes the live Q&A and a walkthrough of all my top trades, you can sign up for a free trial to Macro Insight. If you join our exclusive trading community, you'll get access to our Telegram group, and you'll also get weekly market reports summarizing the macro call. The link is in the description to the video. And for more information, you can connect with us on socials, or you can visit our website, options-insight.com. Thanks a lot.